Hello, guys. So I am going to go solo on this one today, and I'm going to talk all about the Fed. I'm going to talk all about CPI. So if this is not your thing, I highly recommend that you just leave now because I'm probably going to bore the hell out of you. But if you really want to understand exactly what it is that moves the general crypto and stock markets, then I highly recommend you stay because we've got a ton of good content in terms of understanding what CPI is, what inflation rates are, and how it is that we can use these to predict the next moves in the crypto and stock markets themselves. So what I'm going to begin doing, guys, I'm just going to jump straight in. Okay, so everyone's been talking about what is the CPI rate, what is the inflation rate, and there's all these different things that get thrown around. Okay, so maybe I guess the first thing that I will do is actually I'm gonna kind of backtrack. So there's a few things that we should be aware of. One, I'm going to show you actually. I'm going to bring you over to a little notepad so I can go through and show you what I mean by CPI. Okay, so this I'm going to get into all of this later. This all pertains to CPI. So first off, we have inflation. Okay, so inflation. This came as a result of quantitative easing. And I know my camera's shaking at the moment. I don't have my external one today, so it's already on the laptop. So quantitative easing, this is basically quantitative money easing, make it easy to borrow money. So how do you make it easy to borrow money? You just make it free. So you have, how much does it cost to borrow money? Let's make it $0. So everyone's going to borrow money. And this is what happened during the COVID crisis. So it was free to borrow money. Companies could then borrow money and hire staff, pay more staff, grow, because ultimately the economy was crashing. So they need to make sure that everyone has money. Now, another thing that they did was obviously they printed loads of money. And when they say printed, heads up, I won't get into the details, but they don't actually just create money. Any bad assets that, are not going to be paid, let's say it's, I don't know, I have to pay a bank because of whatever. If I cannot pay that anymore, the government will buy my loan off of the bank, knowing that I can't pay it, and then they just kind of close it off. And that's how they kind of justify creating money. Anyway, so yeah, they basically had this free money, plus then they then went and they printed over here, printed money. Here we are. So printed money. Boom. Then they started with this, they started buying assets. So buying assets. And they had about $4 trillion on their balance sheet. That then went up to $8.9 trillion. So this means that the Fed owned 8.9, nearly $9 trillion worth of mortgage-backed securities and treasuries primarily. Now, when people are kind of saying about this, obviously this is inflation. This has come because we had quantitative easing. And so now inflation is currently, let's do a little arrow down here, at around about, 8.3? Ooh, 8.3. So around 8.3%, which basically means that your money is worth 8.3% less because everything else around you has become 8.3% more expensive. That's very important to know. And that's an average. Food is about 10%. And you have other things like things that require manufacturing or commodities like used cars are much more. So it does change depending on the industry. But this is just the overall level that we have in the US. I will say I'm not in the US, but different countries have different levels. Turkey is around 74%. Imagine that. That is awful. But anyway, so we got into this mess through quantitative easing. Now, what the Fed have wanted to do is they've said, right, okay, well, we have two ways of managing this. We can either change this little thing here so we make it expensive to borrow money. So that is a rate hike. So this is the rate at which it costs to borrow money. If you just increase that, then less people will be borrowing money. There'll be less money in the economy, and then there'll be less hiring. There'll be, essentially less going on. So therefore, inflation will come down. Now, that is the first way. The second way is what's called quantitative tightening, which is the opposite of quantitative easing. You don't print loads of money and start buying loads of these dead assets. You actually start selling these dead assets, which is what they plan to do to the tune of, I think it's 49.75 I have the exact figure on another file here. It's basically just a website. I have the exact figure, but anyway, so that's that in billions, not in percentage. My bad. So that is in $1 billion, and they're going to do this every month up until August, and then they're going to double it to 90 billion. Here we go. Then that's going to jump to 90, which is how I know this figure is wrong. I think it's 45 or something like this. I'll show you anyway. But anyway, this is going to jump up to 90 billion every month that they're going to be selling. So this is naturally going to, and this, let's say it's treasury, this is going to flood the market and they're not buying anymore. So then you're going to have treasuries which will have the supply and demand. So I did show you this before. So this is quantitative tightening. I said they were buying treasuries and mortgage-backed securities. If you've seen The Big Short, you know what a mortgage-backed security is. But anyway, so you will end up with demand going down, supply up, which then means that the price of a what is it? A treasury, for example. If there's loads of supply, obviously the price goes down. Then what happens with bonds is the yield is inversely proportional. So if the price goes up, the yield goes down. If the price goes down, the yield goes up, which is exactly what we will see here. So then this causes another issue, because if you have, let's say, a 10-year yield, 10-year bond, you can get a 3% return, which you currently can. That's the current rate, 3% for locking your way in. Literally, it's with the US government. It's the safest place considered for an investor. And that's what a lot of these institutional investors are doing. So instead of putting their money into Tesla, into Apple, into Bitcoin, they're like, well, these are super risky, and I don't know how long this whole inflation thing is going to be around. So if I'm unsure, the best thing for me to do is just take my money out of here and just go and stick it in a nice bond, because I'm going to get 3% guaranteed. Now, that's one thing one angle that I want everybody to kind of be aware of. I will stop this and bring us back onto some charts. Let's have a quick look over here. I do see that a couple of you guys have dropped some comments, so I will get back to these at the end. So let's have a look. CPI. So this is what everybody's talking about, like I said, so less, essentially with the US government, or I should say the Fed, essentially letting go of their bonds, then they're not buying any. Again, you have that supply demand, you have the price, you have the yield. That's quantitative tightening. The second one is raising interest rates, the rate at which it costs to borrow money. Now, this is what everybody's talking about. And so you can see here, 47.5, I should say, and then that doubles to 90 billion. So we have that exactly here. Now, the idea is that it should shrink 1.5% off of the total Fed balance sheet by the end of 2023. And if quantitative tightening as expected or continues as expected, this $1.5 trillion reduction in the balance sheet should be equivalent to another 70 to 100 basis point of tightening. Now, tightening is the reduction in the rate of the increase in the rate of borrowing. So when people say a basis 50-point basis hike, and this is what everybody talks about. So doing quantitative tightening is the equivalent of doing 75 to 100 points. Now, let's have a look. And this is what I want to show you. So you can see here, this is the Fed rate monitor tool. This just tells you with the investors, what is their sentiment? How likely do they think a certain scenario is? So are we going to raise interest rates by 50 basis points from 0.75 to 1? Up to 1.25 to 1.5? Well, 94% of people do think so. So that's very, very likely. And now if we have a look, I just want to show you this. We filmed this on the 4th of June. There was less than 10% in July thought that we would have a higher than 50 basis point. So this from here to here is a 50 basis point hike. The chance of this happening now has more than doubled to people thinking, actually, maybe we're going to have a 75 basis point hike in July, which makes it very bad to be in the typical markets. So if we just have a look at investing.com, for example, we'll be able to see this is what this change over the past week has kind of led us into this scenario. Even just looking at the general indices, we're taking a bit of a tumble down. Now everybody's very worried about what's going to happen. People are beginning to consider, well, actually, the food shortages are not really going away. The European Central Bank has increased the rates, their rates for the first time since 2011. Other central banks are increasing their rates more than expected. So all of the investors in the US market are thinking, well, actually, maybe the US are going to do this as well and increase their rates higher than expected, which is obviously going to be bad for the markets. Moving money, like I said, away from those risky assets into those less risky assets. And you can see down here, so people are then kind of considering, well, this is a 50 basis point here, which is pretty much guaranteed for June. July, kind of guaranteed, but like I said, the chance is increasing that we have a 75 basis point hike. And then we have this. So it's kind of like another 50-point basis hike is generally what the majority of the market is expecting. So another 50 point in September. And then in November, nobody really knows, but the expectation is maybe a 25 basis point hike, and that will then kind of ease up. And I say 25 because this being the most likely scenario, and then if this is the most likely scenario, that will be a 25 basis point hike. Hence, that would lead to an end of year rally. So this would lead to a rally at the end of the year because the Fed starts taking the pressure off. But it all comes down to whether we see a CPI print that is higher than expected or as expected. Now, in 3 minutes, we're going to actually watch this live as it's coming through on Bloomberg. So stick around to make sure that you do that. My internet connection, I'm hoping that it just gets a little bit more clear in a second. But for now, not so much. So that I guess that's everything that I kind of wanted to say. People are moving away from that crypto, the tech, and then further into those treasuries as like a move to safety. I will just quickly show you for, where are we here? So here we have inflation. We also have core inflation. Now, let me jump back over just before I do this. Whiteboard, boom, here. So we're back onto here. The reason why I wanted to break down what CPI is. So the reason why, I guess another reason why I think CPI might in fact come, I don't think that this is going to be the highest CPI print. I think this is going to be, it's either going to be on expectations or above. I don't think this is going to be the highest, and I don't think that next month things are going to get very easy very quickly. And that's because energy and food prices have gone up, housing has gone up, travel has gone up, apparel has gone down, and tech has gone down. But these all combined, let me get rid of that. So these all combined, doesn't matter, together, this kind of makes me feel like, hang on, I feel like we should be, where are we here? Yeah, so the month on month, as you see, so it was 0.3%, expected to be 0.75, and then we see the, but it's 0.75 annualized. Why am I having so much difficulty here? 0.75 annualized is actually 8.4, which is far more than the standard 8.3 that we're at the moment. Year over year, it was 8.3. It's expected to be 8.3. I've just deleted that. And then core was 0.6%. It's expected to be 0.5. And that's without energy or food. And then in 1.5 hours afterwards, we have the consumer expectation. Now, the consumer expectation is basically for consumers, what do they expect that in 1 year we're going to have inflation at? So, generally people are saying, well, the consumers are going to say that in a year we're okay with having, not we're okay, but we expect to have 5.3%. If this, okay, we've just had the print. So what we see is actual, so inflation 6%, and the actual is 8.6. So this, again, like I've just said here, guys, we had a massive print over what was expected. And so let's have a look at some of the markets. Just head over to, let's say, coin market cap, for example. I reckon there's going to be a sell-off. So we're seeing some of the prices. They haven't come down just yet, but we will see them. Let's go over to here, have a look at the S&P 500. Boom, S&P 500. Let's have a look at the NASDAQ, QQQ. Jump onto this. Boom, another one. So pre-market, obviously these guys are not quite open yet, but the pre-market, we've dropped down quite a lot, actually, 200 basis points. That is a big drop. So the overall expectation, guys, from this is that because we've had this print here, core inflation is above what it should be. The inflation rate year over year is above what it should be. It shows the Fed that they have to do a lot more, and i.e. speed up their quantitative tightening, or they have to increase the interest rates massively. So this is going to then mean a massive contraction of the economy, potential recession, and that's why everybody is moving out of these risky assets, just in the same way. And the same will probably ring true for crypto. Let's have a look at Bitcoin futures. Where are we? Still pretty similar. BTC USD. Let's have a look at this. A bit of a sell-off, but I'm on the 4 hour. Let's go on to the 15-minute bomb. Exactly. See, so this is one thing that we mentioned, guys, in our previous video just now. I always say watch out for the Fed. This is exactly what we're doing. Imagine if you thought this was a solid level of resistance, or sorry, support. We're breaking through this. So this just really kind of shows what I've always said, that we need to follow these bits of news. It's these guys who move the market. Looking at the charts don't lie, unfortunately. So this, I think, is going to have a lot of selling pressure. This will probably continue. The market is not open yet in the US. I believe they have half an hour until that does, but we're going to see even more selling volume, I believe, in Bitcoin, also across the board, and everyone's going to be worried and moving into treasuries. So if I just have a look at the 10-year treasury, 10-year yield. Where is it? US 10. So the yield has gone up massively. So here you go. I mean, look, that's all I wanted to say, guys. Obviously, watch out. You were going to see this across the board. Bitcoin still dropping ginormously, not great, massive sell-off, going to continue. And I would also expect that it would, I'm just going to bring up a random coin, ADA, massive sell-off across the board. So here you are, guys. Follow us on Twitter. We're going to need some new support areas across the board. Everywhere's going to be in a bit of an issue, a bit of a disaster, I should say. If you had any stop losses, sorry, but they've probably been hit. That's probably a good thing. And I would wait to go long. I would wait personally. If I'm going to be going long, I'm going to be waiting to find a little bit of a new area of support. Let's just bring ourselves back onto Bitcoin, for example, because that will make the move first. Any comments, just quickly drop those in. I'm not currently looking at the screen, but I will do. And you see, so this CPI, I said it was going to crash the market. It has crashed the market. And so that's the reason why I put that as the title. So there you go, guys. I can't really say much more. Called it. Here we go. And I hope that you guys just trade safe. Don't really get into anything for now. You might want to try and buy the dip. I do think we might be able to buy the dip, but there's such a bigger element of this is not just an intraday trade. This is a fundamental thing that might carry on for another 2-3 months until we see a CPI report that is actually either on par, because this just shows off by 0.3%. The Fed don't know what to expect. They don't know how to forecast their own economic system, which is a disaster. So they're going to have to do a lot to get that under control. Anyway, that was everything from me, guys. Hope you had a good session watching me. And I will look forward to seeing you in the next one. Take care, guys. All the best.